Hey, good morning, everybody, and welcome to another daily market report brought to you by Mike York. Today's news, we got the NFIB Small Business Index. This is basically kind of reporting that the small businesses, their confidence level, still kind of showing some type of recessionary levels. So anything really below 100 is kind of thought to be in the recessionary numbers. So still not a lot of confidence in the market, kind of stuck. But they are seeing that they are kind of ceasing the job reductions and maybe looking more towards job creation. So that could be a positive. Job openings has dropped a little bit from 3 million down to about 2.93. They're out there. Wholesale inventories up a little bit, but still at pretty low levels there. So as you can see here, the stock market's down today. This is primarily weighing on because all the news that came in last week from the elections to quantitative easing and such last week that they're still kind of digesting. What is this going to really mean to the economy? There's still obviously Congress still needs to get stuff in order before end of the year, so they might be kind of waiting watching there. And we're at kind of levels we haven't seen since the recession, since we're up by 11,000 so far. So we haven't really been at over 11,000 for a while. So let's go ahead and take a look at the bond market, if we would here, and let's see. And we got here, we had a huge, almost 50 basis points drop for a gap. And then right now we're down even lower from the 28, another 28 basis points, as you can see here. So this is almost 78 basis points. This could knock us back probably about at least 3/8 to 0.5% in mortgage rates, possibly. So depending on how the lender is doing the pricing, but it could be a pretty big drop, worsening in the mortgage rates today, just on this base alone here. I don't anticipate seeing this because there's really no strong economic news that came out that's going to really push this. Uh, what it could be, perhaps, is that maybe China's also upset with the U.S. for this quantitative easing, thinking that they're kind of flooding the markets with too much liquidity, especially right now when they feel when there's financial crisis, they felt it was warranted the first time, but the second time they didn't feel it was really wanted. They're being critical of the Fed for doing so. There's also concerns, obviously, brought up about Ireland, about their debt fears, and now there's also Microscope underneath Portugal as well, that maybe they might continue to have some issues here. So this is something definitely to watch for, but I don't anticipate this. They're probably also kind of watching to see what the quantitative easing really is kind of playing. The bond traders are also probably looking at that, kind of taking a step backwards, probably going on the conservative side regards to where the bond price should be. So taking more of a step back and kind of looking where the price should be, as quantitative easing is inflationary. The government, they're trying to push inflation, whereas that's the enemy to bonds. But yet they're going to be buying this, so some of this again, they're looking at this could be another bubble ahead for these assets the government's buying. So this is some of the concerns that are out there. All right, you guys have a great day. Anything else pops up, but again, this is a huge gap, and there's really no explanation really as to why there's this big of a gap. It should not be, and I wouldn't be surprised if it closes up over the next couple of days here, because like I said, that's a pretty big gap, and usually when we have big gaps as we see, they always kind of close up. As so these gaps here got closed right up here over the next couple of days. So, all right, folks, you guys have a great day, and be in touch with you soon.